Bro, it's a miracle that we get the show out on time every week. Are you having trouble with that? I don't know. I'm having so much. I thought I was good at scheduling. Today was like a nightmare. I don't know what I'm doing wrong. I feel like it's miraculous that I'm here. Wow. Look at the live chat right now. Special shout out to Adam Johnson. Special shout out to Tom Whalen. Lil Buffett's in the house. We love Lil Buffett. Who else is here? Riley T, Eric Sprung, Alex A, Rich Ramsey. What's happening, my man? Let's see. Matthew, everybody's here. Duncan's here too. We had viewer topics. John is here, helping us with the charts and music and whatnot. We have so much to get through, so let's not spend any more time. What do you think about that, Mortimer? Are you ready to rock? Yeah, are we back in business, Mortimer?
Come on.
All right. Do the Y charts thing. Okay. Let's just address Space Billionaire. You know what my first thought is? It's not one of our topics. You know what my first thought is when I saw this guy, Richard Branson, I guess, get into like as close to the space as possible. Like he just barely got through the atmosphere.
What was your first thought?
My first thought was, this guy's not Jewish. I can't imagine a Jewish billionaire like taking that much money and saying, "This is what I want to do with this. This is what I want to do with this." And I ran through the list in my head, like Jerry Reinsdorf is not doing this shit, and Michael Bloomberg is not doing this, and even Larry Ellison, who definitely could do this, is not doing this. So congrats to Branson. I know
he's like the ultimate outdoorsman. He's a spaceman. He is. You are an indoorsman, big time. The great indoors.
The other thing is, I feel like I know world hunger is an issue, but it's really important that we got one of these guys into space and another one on deck. So maybe there'll be solutions to other problems we have that come out of the science from that. I'm very excited. And I hope they make another $1 trillion each. So it's all good. All right. Why would anyone sell stocks?
That's a dumb question. I mean,
no, that's not what I mean. All right. Let me set this up.
Go ahead.
This is Wall Street Journal looking at the borrowings of investors against their portfolios. And I feel like this is a very undersung part of why stocks behave the way they behave, and why wealth inequality has exploded in the last 10 years. So
I'm not a magazine cover person, but like, man, that looked pretty damn toppy to me.
Okay. So securities-based lending allows corporate insiders all the benefits of selling stock without having to actually sell any stock. You get all the liquidity to do other shit, and you don't lose your voting rights, and you don't even pay taxes on capital gains. Plus, the investment banks are getting paid, and the financial advisors get to tack on an extra fee for selling you the securities-based loan. By the way, I'm not anti-securities-based loans. We make them too. We don't get paid on them. We do it as a service. The banks are making a fortune selling these things. But just the point that, like, let's say you're a vice president at like Tesla or whatever. You have all the benefit of the fact that stock has run up, but you don't actually have to sell any of it to live the lifestyle as if you did, and you definitely don't have to pay taxes. How is this so easy for everybody?
What do you mean exactly?
Like, why is this working so well for everyone? Well, like, why is this a thing that's possible?
Well, I guess
how does this go wrong?
Because interest rates are so low. It's very simple. So Merrill Lynch, what?
That's not new.
But so talking about like inequality and how this works, Merrill Lynch makes loans. If you've got $100 million or more, and they'll give you a loan for as low as 0.87%.
Right, it's free. Money.
3.2% if you have at least $1 million. And that's not a very high hurdle rate.
It's not a margin loan, and so you can't buy more securities with it. You have to withdraw it and do something away from Merrill Lynch, right? It's also not an underwritten loan, so it's not like one of these home equity piece of shit processes where you sit there for 9 months waiting for an answer. This is instant cash loaned against your bonds and your stocks, and you really don't have to do anything to make this a reality. Like it takes
how this goes bad is obvious. You use the money for something unproductive, or you go for an investment and you swing and you miss, and you owe the money back. You have to pay it back. Or if you borrow too much and the market crashes and you get a margin call.
I don't feel like that's happened to anyone yet. We don't have crashes that last longer than 15 minutes.
Well, I'm saying that's how it goes bad.
I'm only half sarcastic. Morgan Stanley Wealth Management clients have $68.1 billion worth of securities-based and other non-mortgage loans outstanding, which is more than double 5 years earlier. Yeah, no shit. There's no consequences. Stocks do nothing but go up. Bonds do nothing but go up. What are you afraid of? Unlock the value of your portfolio now.
So in ways that like people say the Fed is creating income inequality or exacerbating it. This is it. This is it right here. If you've got $100 million and you could borrow at less than 1%, you're good to go. Like it's very easy to lever that up and make basically risk-free returns.
Right. So like 15 years ago, when you would look at insider selling in like public companies, right, and you would see like 3 executives sell, you'd be like, all right, like maybe one guy's paying for his daughter's wedding. Maybe this woman is selling because she's getting close to retirement. They don't even have to do that anymore.
They're not selling anymore, right?
Right. So I also think this invalidates looking at insider buying, selling as some sort of an analytical tool. Not that anyone really does anymore.
I really don't see anybody using that very frequently.
I think that's over. Did we pop this chart? The borrowing boom. Did we do that already?
Yeah.
And I missed it?
Yeah.
Okay.
Yep.
All right. Anyway, why would anyone sell? There's really no reason to unless people feel very confident that the stock in the company they work for has topped
like
forever.
People with a lot of money.
Well, that's what we're talking about.
Yeah, well, I'm just saying that's who you're talking about.
No. A regular person sells to pay their bills.
Right.
These people borrow to pay their bills.
Right.
And seemingly without consequence
so
for years and years on end.
People with a lot of wealth have always had an advantage. It's no different right now.
Well, what's different is it's 5x what it was 5 years ago. What did I tell you? 4x?
It went from 30 to 68.
So double what it was 5 years ago. That's the difference. It's bigger, like everything else in this world. Yeah. All right. What do you got?
You've made this astute observation in years past to never show a profit. So these are not
I'm the smartest man alive.
These are not apple to apple comparisons. But Dave Nemetz tweeted, NextDoor, which is an app for, I guess, neighborhoods. You can find services and all sorts of stuff for your local community there. Has a $4.3 billion valuation versus Buzzfeed, which has a fourth of the valuation and actually has profits, significant profits, $31 million compared to NextDoor's $75 million in losses, and has a much smaller valuation. And why? I guess because Josh, your theory has been that once you show a profit, then there's no more dreams. Like there's no more pipe dreams. Like once you've showed profit, this is all, that's it. That's all there is. You're better off showing losses.
Right, because then there's something to comp to. If there's no profit, how the fuck are you gonna put a multiple on it? You can't. Actually, you know who I learned this from? Howard Lindzen called me up like 6 years ago or something. He goes, I have terrible news. I'm a shareholder in StockTwits. And he goes, I have terrible news. What's the matter? He goes, we're profitable. What do you mean? Like StockTwits made money in 2015 or whatever it was. I go, why is that bad? He's like, because now people put like a multiple on it and we have to grow it. And, you know, it's just like we were like a hot startup and now we're like an advertising company with a business and a profit. And that's a huge problem. And I thought he was joking around, but the more I see recently in IPOs, like the more every instinct is telling me, why on earth would you possibly come public showing how profitable your business already is when what you really want to do is keep people's imaginations captured with the idea of how profitable you could someday be.
Well, grow the company, have explosive
profit.
Losses, just grow the top line, grow your user base, and worry about that later.
If your losses are doubling but your user base is quadrupling, I feel like you're a home run on Wall Street. Why on earth would you be like, look how much we make per user? I think that's a huge tactical error for anyone.
Well, because then there's like a ceiling. It's like, okay,
I'm taking all the profits from the firm this year and spending them on undisclosed things so that we don't run into that issue. Okay?
Beautiful.
Okay. $9 trillion binge. This is nuts. We spend time talking about inflows in ETFs and like, did investors put money into bonds or stocks this month? And who gives a shit? Because there are like 3 whales in the market, and they basically dictate the direction of everything and the psychology around every asset. And it's never, it's been this way for a while, but it's never been more obvious to me that paying attention to what central banks are doing is probably more valuable than paying attention to what any individual investment management company is doing, what any hedge fund is doing. Do I have that wrong, do you think?
No. I mean, don't fight the Fed is like a pretty common adage.
All right. So, quote, since the start of the pandemic, central banks in the U.S., Europe, and Japan have been on a $9 trillion spending spree. That binge has turned the U.S. Federal Reserve, the ECB, and Bank of Japan into the ultimate market whales, swelling their combined assets to $24 trillion. $24 trillion sounds like a lot of money. That's just the 3 largest central bank balance sheets. That's the level of assets they're sitting on. That's not even what they continue to buy. So now, here's my question. Arguably, the psychological impact of all this buying, this is me, was every bit as impactful as the dollars themselves. Like, I think we would all agree, just them saying what they were going to do was really, really important.
That was the bottom.
To the way other people behaved.
The market
that was the
bottom
bottom.
Yeah.
Right. So will the same be true as all of the asset purchases reverse, or is it not that simple?
Well, they're not reversing. They're just going to stop buying.
They're going to slowly buy less until they're buying none, which could take 18 months, but that's the direction. Directionally, that's where things are headed. We know that now. They're writing op-eds trying to prepare us that this could actually even happen like next month or the month after. So the question is, will the psychology, forget the dollars ebbing away from asset classes, which will happen slowly, will the psychology be as affected on the way out as it was on the way in?
I mean, you would think so. But what if they stop buying and the market doesn't go down? And now people are like, oh, we could stand on our own 2 feet. Maybe that's bullish. I don't know. I don't think that they're going to taper and then all of a sudden the market's going to crumble.
They
could happen, but
Bernanke slipped in an offhand comment at a Senate testimony in June of 2013. They didn't actually finish tapering until I think January 2015. So that was a very, very long process of tapering.
Also, don't you think the market's reaction is going to impact their decision? Like whatever they say is not set in stone. They're going to throw something out there, see how the market reacts, and adjust, I think.
Well, we know this because you could take all of these inflation measures and all these employment measures and throw them out. The Fed reacts to the 200-day moving average of the S&P. Like all you have to do is look at the end of 2018 to understand what the Fed is focused on. And I don't even think that's so wrong. I feel like that's almost like a shortcut for the Fed. Chart off. Like if they just focus on a quick bear market for stocks that doesn't seem to be getting better, and then they come out and say, okay, we're still tapering, but much more slowly, or whatever they have to say, that's probably better than relying on backward-looking economic data that's noisy as hell and unreliable. So I think the Fed will be paying a lot of attention to market sentiment and probably price. And I guess I could live with that. This thing with mortgage-backed securities, I know you're not going to second-guess the Fed, but shouldn't they just stop doing that first?
What do you mean? I think they should stop. I think they're doing $40 billion a month still.
What if they kept buying treasuries and stopped buying mortgage-backed securities?
Listen, I don't want to the world. The thing is, I don't want to pretend to be an expert on what impact this has on the housing market. But just as a layman outsider, I don't understand why they're still doing this.
Well, all right. Let me ask you this: as a layman, is there anything that the housing market needs from the Fed currently more so than what they've already done, or
higher interest rates?
Do we think we're good now? What if we were stimulating buyers by knocking off all the housing-related stimulus and letting prices fall a little bit. Wouldn't that be a form of stimulus if household formation could take place at lower sticker prices for homes? What if that's a better stimulus than stimulating the sellers all the time, which is what we've been doing?
I don't disagree.
Yeah. I'm gonna run that one by some people and see if anybody cares what I think.
How do we stimulate buyers? Seriously.
By making it more affordable to buy a house.
So if they stop buying mortgage-backed securities, are interest rates going to rise, or mortgage rates going to rise?
I don't think they're going to scream higher, but if there's less liquidity in the system, then it's
you
harder
would
to
think
get.
So.
It's harder. It's not harder to get a mortgage is not the goal. Harder to get the size of mortgages that people are getting. That's where things are getting out of control. It's the availability of the size of these mortgages that's driving the prices.
But at the same time, the quality of the buyers has never been better as well in terms of credit and money down.
Which I have no problem with. That's a great thing. We know why that's the case also. I have no issue with that. I'm not calling it a housing bubble. I'm basically saying, like, we're so focused on driving prices higher, which is great for sellers. Sellers is code for boomers, right? Who are probably selling their home and then downshifting into a rental or moving to Florida or whatever. What if instead of that, we stimulated buyers by letting prices fall with less liquidity in the system and made it easier for millennials to buy their first homes? Why wouldn't that be a better form of stimulus? So
yeah, I mean, it's fine. So interest rates come up, housing prices come down, but then your mortgage payment goes up.
Well, listen, there are always trade-offs, but I just feel like having a runaway train of home prices is not economic stimulus. Not at this stage. Not anymore. That part is over because now rental prices are going up too. All right, let's keep moving.
One of the big worries with all the stimulus that the Fed and the Treasury were doing last year was that we're going to be overrun by zombie companies. And what are zombie companies? Well, it depends how you define that. But for this, let's just go with an interest coverage ratio below 1, meaning that the interest expense on a company's debt is more than their earnings. That's not good, right? So these are companies that are just
so all their profits have to go toward making debt.
Just companies, I guess, that are worth more dead than alive.
Okay.
And actually, zombie debt fell to $30 billion at the end of 2020, the lowest level since 2009.
All right. So this is Tracy Alloway's story. And shout out to Tracy. We love Tracy and Joe's podcast, and she's a hell of a reporter. And she wrote this at Bloomberg. So people are let's set this up correctly. People are complaining that all of the extraordinary stimulus is making it so bad businesses are being kept alive artificially.
Correct.
And that's something that you will frequently hear the Austrian economists say, and the nihilists, and the people who are mad that they're not long. And like this assorted group of like very doctrinaire economic speakers and thinkers who want to see lots of bankruptcy and lots of failure because they argue
they don't want to see artificial stimulus.
And I agree with them actually. They argue that you need creative destruction, you need new companies to be able to come along, and bad old companies to be competed out of business. I agree with that.
I think most people do.
Everyone does except for somebody who runs a zombie company. But what's hilarious about what Tracy's saying, on the surface, she's like, no, actually, that's not going on. Zombie debt fell from $70 billion to $30 billion from 19 to 20. But what's actually happening is that's because of who gets categorized as a zombie. You had a lot of companies that are now investment grade that were pieces of shit before the COVID crisis, and they were able to term out their debt and borrow at larger numbers for longer at lower interest rates. So actually, Tracy's kind of like not glossing over it. She mentions it, but like what's really going on is we didn't kill zombies and wipe them out through creative destruction. We put lipstick on pigs and we allowed these companies to get more liquid, improve their balance sheets, and not be zombies anymore. So I guess that's kind of awesome, especially for the people who work there. Like, congratulations on that. But, so yes, we don't have a zombie debt crisis. I think the number in the article was it's like $8 billion in a $1.5 trillion junk bond market. Who gives a shit, basically?
Yeah, drop in the bucket.
Okay. Goldman. No, what are we doing? Yeah, David Kostin, who I like and think he's smart, is talking about the idea that like we may have seen everything we're going to see for the S&P 500 this year.
Fine, it's up 18%.
Well, thanks for stepping on my tail. I wanted to ask you, like, and I know you did a little bit of work for this. Let's say we're flat between now and the end of the year, which might even be wishful thinking, by the way. Where would that put 2021 in historical context in terms of stock market returns?
This blew my mind. The median annual return for the S&P 500 is 14%.
Okay, the median. So we're in awesome shape then.
So this is showing through June, the first 6 months of the year. It's going back to 1950. It's the 10th best year out of 72. So pretty good. But if the year ended here, so going back to 1926, that gives us around, I forget what it was, 93 years, something like that. This would be the 43rd year. So just better than middle of the pack.
So this, if we finished up, what'd you say, 18?
18, 17 something, yeah.
I mean, that seems like an amazing year. What, like,
dude, the market was up 18% last year. If it's up 70% this year, I think we're okay. And how about this? If it was down 10% this year, I think we'd be just okay.
Wait, most investors would accept a 10% drawdown from here, and we end the year up 8%. That's like not a bad return, especially considering where interest rates are. I understand nobody wants it to drop 10% from here, but just this idea that like, when is enough? We were up, how much were we up last year? What was
18%? I'm saying 18%. 18%, right? Year.
So 18% plus 18%. Like, when is enough? People are like,
I'm full.
Bored.
I'll take no more gains for the rest of the year.
Dude, I would gladly take the second half of the year off and start back up in January. All right, so here, this is from Kostin. He basically is saying Kostin continues to expect growth stocks to outperform value in the second half of 21 and into 22. The shift may be underway. Yes, we know Microsoft and Apple were two of the top 5 performing S&P names today. Both made new highs. Congratulations. He's, I guess his take is that the 10-year yield will be closer to 2%. Multiple expansion will slow, and a lot of the benefit of earnings growth we've already accepted. So do you feel like that's the consensus right now?
I don't know I don't know what consensus is. That's like impossible.
I feel like that's what people are.
But with the 10-year at 1.4, I don't think consensus is for the 10-year to be at 2 by the end of the year.
He's at Kostin's at 1.9. I think most of the strategists are above 1.5%. So,
I don't know. All I know is that if the market goes nowhere for the rest of the year, I'd be perfectly happy with that.
I mean, considering what we've been through and considering where this could have gone, I would agree.
I was curious to see. You don't see this very often. Aswath Damodaran, professor of, I guess, finance at NYU, like somebody with that pedigree telling another person in the investment world to basically shut the front door. Like, you don't really see somebody getting called out like that. At least I don't. But Damodaran was asked about markets approaching bubble territory. And the person said, Dr. Michael Burry, this is part of the question, has warned retail investors about the mother of all crashes. And Damodaran said, Michael should have retired after the 2008 crash, right after The Big Short came out. The market gurus take themselves too seriously. You're in the right place at the right time. You look like a market expert. And this is a shot fired. I think there are people who think deeply about the markets. Michael Burry is not one of them.
See, that's the part. That's where it got personal. Did Burry clap back or not yet?
I haven't seen, but it is interesting. I was thinking about this. So Michael Burry has one of the best track records ever. From November 2000 through June 2008. So obviously he called the housing crash. He made 489% for his investors. The market was up 3% over that time period.
Yeah.
So I think a lot of people like that.
Nobody could take that. He did it. Nobody could take that away from him.
So I think that people, obviously the best investors of all time have made a shit ton of money for their investors. Druckenmiller, Burry, but their public track record for market calls is not very good, which I don't know.
These fucking guys need to get off Twitter, Demoterin included. These guys like sticking shivs into each other. It really reminds me of Oz. It's like they're all trapped in this like macro genius cage match. They're like appraising each other's tweets and ripping each other to shreds. If they sat down at dinner and talked about the state of the economy and the markets, they'd probably have a great time. The nature of that app is to set up these cage matches, these blood feuds. It's so dumb because they're both really respectable guys.
This wasn't Twitter. This was Demoterin asked. And Burry, by the way, did delete his account. But to Michael Burry's credit, I know he's got like a cult following. He made that call in I guess in maybe 2004. I don't know when he first started turning bearish, but he nailed it, obviously. And then it would have been easier for him to get like power drunk and just start making calls all the time. He didn't make a public market call until 2017. However, what he said in 2017 was, he was calling for a global financial meltdown. He said, quote, "I didn't go out looking for this. I just did the math. Every bit of my logic is telling me the global financial system is going to collapse." And the market's up 93% since he said that. This is a scorecard somebody put together of his market calls.
Yeah, nobody should be doing these market calls in real time. They're never smart. Like, this is as good as Jose Canseco's record. Like, nobody should be doing this stuff. But it doesn't matter. It's none of my business if people want to do it. I think with Burry, like, this is like obviously a next level brilliant person who probably, if he said less frequently, like, would be in higher esteem amongst people like Demoterin and others. But that's like the nature of constantly commenting on every move the market makes. It's really hard to like maintain credibility, no matter how successful you've been, or no matter how smart you are. It's just it's a hard thing to do. Well, and I actually don't even understand the benefit of it to him.
The more calls you make in public, the more you're going to be wrong, obviously.
Yeah, I just feel like it's this calling the top. It's the biggest. How is it the biggest bubble ever? Is that what he said? This is the biggest bubble ever, Burry? It's when 19 times earnings and multiples are going lower this year.
A global financial meltdown in World War III. I mean, that's not helping anybody. All right.
It's not my business what other people say, but like this is not a good look. Like, this doesn't look cool, guys. It's not cool to rip each other. It's not cool to be constantly throwing the word crash around. It's just not hip hop. I don't know how else to put it. But you know, do what you want to do. All right, are we going to Duncan Hill?
Hey guys,
here he is. Dude, you were ready.
I was waiting on the button.
You came in guns blazing. Duncan, how are you today?
Doing well. How are you guys?
All right. Chilling, man. What do we got for our first viewer topic?
All right, so first up, John writes in with a very straightforward question, but I think a good one that a lot of people probably have out there. John says, "I wish the world would stop saying tapering. Can you explain what's being tapered? Rates, Fed purchases? Some of us don't know."
Michael?
What?
We're on the air.
Can you explain what is being tapered? So, no, it's not rates. It's the speed of purchases. So if they were buying 120 billion right now, that's their pace of purchases. They're going to slowly discontinue purchases. So maybe it'll be 100 billion, then 90, and all the way down to zero.
So the Fed is using its balance sheet to support asset markets, and tapering represents them very slowly removing that
their
support.
Foot off the gas pedal.
Yeah, by buying less, as opposed to just being like, all right, COVID's over or the recession's over, we're just done. Like, they do this very slowly and deliberately so that there's enough certainty in these markets that people don't go crazy. So tapering is a good thing unless you think we should still be at emergency levels of stimulus, which I don't think we should be. And I think the sooner we get into tapering and people get over it, the more normal the environment will feel. Just a personal opinion.
So it's just in the interest of market stability, basically, is the idea? Okay.
100%. That's what it is. So you have to withdraw liquidity slowly. You can't just slam on the brakes and say, all right, we're getting out of these markets, because people need time to mentally adjust in the way that they're managing their own portfolios.
All right, cool. So next up, we have a question from Thabo in Cape Town, South Africa, which I think it's like midnight there. So I don't know if he's watching or not. But so
Oh, he's watching.
yeah. Hopefully he's watching. So he said, "Thanks for a great show. Always appreciate your thoughts." He also says he hopes I get you guys into F1 because you're missing out. Then he says, "Speaking of speed, I would appreciate a simplified explanation about what I should read based on reference to the VIX. I always feel like it's an indicator used to predict sentiment when it sounds like it's telling you what's already happened. So I'm not really sure what to read into what it predicts."
What's your hottest VIX take, Batnick? Scorching.
As far as what he should read, Andy Thrasher did this really good piece on volatility. I think he won an award for it years ago called Forecasting Volatility Tsunami. I think what the VIX tells you is what just happened. You're exactly right. It's not, in my opinion, it's not predictive. It's a measure of expected volatility in the S&P 500 over the next 30 days that's derived from options and how much volatility investors are pricing in. But yeah, when the VIX is low, that's because the market is calm and people expect it to remain so. When the VIX spikes, it's because the market goes haywire and people expect that volatility will continue. It's completely backwards looking.
Yeah,
that's my take.
No, I think it's obviously a coincident indicator because it's measuring the amount of people buying bearish options versus bullish options and trying to gauge the current fear that's in the market through the prism of options trading. But it's not predictive. And
if you look at a chart of rolling 30-day returns and you overlay that with the VIX, that's basically what it is. So it's basically looking at what just happened.
Yeah, I don't want to oversimplify what Thrasher did, but like I think the oversimplified version is that prolonged periods of very, very low VIX or low volatility will eventually lead to volatility spikes. And if you're fast enough and you're watching the right things, there might be a way that you can see that process happening and that low vol flipping to high vol in real time.
I also don't know. I don't know enough about this, so I might be making this up, but there are so many more ways to hedge a portfolio right now than like so many different instruments. I don't know if the VIX captures the market the same way that it used to.
Well, I think that's a really important point. Like you can express bearishness or you can put on hedges and totally bypass the options market. Think about how many ETF products will let you do that. Think about what you can do with S&P E-minis and futures. So I think that's a really important point. Not every hedging trade or de-hedging trade will show up in the calculate, but I have to believe that in extreme moments, like these things will line up. Like when there's extreme fear, you'll see it everywhere. The VIX won't be an outlier. So I think like you really should be paying attention to the VIX at extremes. And when I say paying attention, you should be ready to fade it, right? Extreme calm or extreme panic are not conditions that last long. Nothing mean reverts like the VIX in both directions. So that's the way that I would think about it. I don't know. I'd start reading books about it. I don't think it's that interesting. Michael, Suns or Bucks? We're being asked on the comment stream. What do you think? Next game's Wednesday.
Giannis looks so dominant. I think they're going to take. I think they're going to take Game 4, and then I'd be nervous if I was a Suns fan.
You'd be nervous. It's 2-1. Giannis seems healthy or healthier.
I've never seen him play as well as he did in Game 3.
Middleton is still knocked down. Lopez is still Lopezing.
He needs to get his head out of his ass. Start making some shots.
But he will be. I think he'll step up. They looked great at home. I think we can't deny that. And all right, I'm still rooting for the Suns. Who are you rooting for? Do you care who wins?
I don't care. I'll be happy for either Chris Paul or Giannis.
Yeah. Both of those gentlemen deserve to win something someday, and I feel like there's a little bit more urgency for.
Well, Chris Paul's days are he's 36, so
little bit of urgency there. All right, we love that you guys are tuning in for the live premiere. We have so much fun. We check out all your comments. Thank you so much for all the likes. Really, really important on YouTube. If you like the show, smash that button for us, the little heart button. Make sure you subscribe to the channel if you haven't already. This shirt is available at idon'tshop.com. It's brand new. It's black. It's super tushy material. I don't know what kind of material this is called. But you'll
Did you call it
absolutely love
tushy?
Yeah, it's like a tushy T-shirt. You don't say that word?
I never heard
It's not a
tushy
thing?
before.
My kids say that. I don't know where they
interesting.
got it from. Where'd you get your shirt from? That's pretty dope. Duke
Instagram.
Brothers. I forgot. All right. Thanks to Duncan. Great job today with viewer topics. Thanks to John. We will see. Oh, you want to submit a viewer topic? Don't forget the email address. askthecompoundshow@gmail.com. You guys are sending great stuff. We love all of it. We try to get to as much of it as we can. So keep those topic ideas coming, and we will see you very soon. Next Tuesday, in fact. Have a great week.